What is going on, guys? Welcome back to the channel. I hope you're all doing good and having a great day. So in today's video I want to talk to you guys about a stock market investment strategy called dollar or pound cost averaging. It can be one of the simplest and most effective ways to actually invest in the stock market, saving you time and money, and it can be particularly relevant to beginner investors who maybe have a lump sum of money to invest. So in this video I'm going to go over exactly how this investment strategy works and also how I use the ideas in my own investment strategy. This particular topic was a request from you guys, so I really hope it's helpful. But if you do have any other video ideas or topics you'd like me to cover, feel free to just drop them down in the comments, because it's really great for me to make content that's directly applicable to you guys, so it can hopefully be helpful to more of you out there. Now before we get into it, if you are new around here, welcome to the channel. This really is the place to be for all the most relevant information on UK finance. So whether you're looking for the best bank accounts or credit cards out there at the moment, or if you want content on investing, making and saving money, this really is the place to be. So if you're not already, make sure you hit that subscribe button down below and click that bell so you never miss a video. And I know it is a bit cheeky asking before the video's even started, but I'd really appreciate it if you guys could smash that like button, as it does really help me out with the YouTube algorithm, and basically allows YouTube to share these videos to more people that might find them useful or interesting. And as always, just as a quick disclaimer, this is in no way financial advice. I'm simply just outlining information and giving my honest opinions and thoughts. Always make sure to do your own research and due diligence when it comes to your finances. But with all that out of the way, let's get into the video. Okay, so just before we get looking at exactly how dollar or pound cost averaging works, I'm just going to go over exactly what sort of investments I think it's relevant to, as it can be effective in a whole range of different markets, including the stock market and other asset classes. However, that being said, there are certain opportunities that it won't be appropriate for. But we're just going to be looking at using this investment strategy within the stock market today. So the main thing to understand is that whatever investment or stock it is, the one thing that it has to have is long-term value. So long-term for me would be something that offers significant growth potential over at least a 5-year period or more. So this might be an individual company, index or fully managed fund. One example might be the S&P 500, which is an index made up of the 500 largest trading US companies. So looking at this particular index over a long period of time, it offers a consistent uptrend pattern with significant growth each year. And on average, this particular index generates between 8 and 10% a year in growth. In contrast, something that wouldn't be appropriate for this particular investment strategy might be a penny stock. So typically with penny stocks, they have significant spikes of growth that can be very profitable for traders that buy into those positions for a brief moment of time. But then more often than not, they stagnate, pull back to exactly where they were before the spike, and don't really offer any long-term value. So although there's money to be made from taking a short-term position, it's more likely than not going to offer any long-term value. So it's really just a question of finding investment opportunities that you'd feel comfortable leaving your money in for a long period of time, and have done your part in finding something with a consistent uptrend, even if it may not have as much growth as some other things out there. Now in terms of finding investments, I'm not going to go into that in this video. There are a number of videos on my channel going over how you can find investment opportunities and how to get started as a beginner, but I'll also be making more content on this in the future, so do keep an eye out for that if that's something of interest. Okay, so now we know what sort of investments are appropriate for dollar or pound cost averaging. Let's now look at exactly how it works as an investment strategy. So the whole idea is that, say an investor has a particular amount of money that they want to invest into the stock market. Rather than buying shares all at once at one period of time, or trying to time the market, you simply just drip feed that money over a period of time into those investments. And the reason this is so important is because the stock market is constantly fluctuating, with there being constant dips and highs due to variables like world news, economics, and sometimes political reasons. Now with this volatility, it makes it almost impossible to buy on the dips and sell on the highs to make it advantageous for the investor. And obviously in an ideal world we'd all be doing this, but it's really just not that simple. And if you do want to try it, it's going to use up hours of your time looking at the markets and seeing what's going on with the world. Now all credit to people that can do this and use the volatility to their advantage, but that being said, a lot of investors, including myself, are more drawn to the passive income side of investing, where you don't actually have to spend all that much time managing your investments, and it frees up your time for other profitable ventures out there or other activities you just want to do. So the idea is that with dollar cost averaging, you find the investments that you want to invest in, drip feed that total amount of money that you intend to invest over a period of time to essentially reduce the impact of that volatility. So in the future, with hindsight, maybe you'll see that certain points that you bought in at weren't necessarily the best, but other times were maybe quite beneficial. And by drip feeding that money into the market, it'll average out the good and the bad buying opportunities. So hopefully all in all, you'll be ending up with some profitable investments. Now, like I said, this particular strategy can be particularly beneficial for those entering the market for the first time, who maybe have a lump sum of money to invest. So for example, you can stagger that money into monthly incremental investments. Or it also can be really useful for those who want to invest their savings. So for example, say you want to save £500 each month, you could put that £500 consistently into your investment portfolio. Now some believe with this particular strategy you're actually going to limit your returns compared to if you were trying to time the market and buy the dips and sell on the highs. Now this may be true in certain situations, however it's a genuine factor that a lot of people, and especially those who aren't particularly experienced, can get too caught up in watching the markets and doing things like overtrading, panic selling, and generally just overthinking certain situations and letting the emotions get the better of you. And I'd say if you experience this, dollar cost averaging might be a good solution moving forward. So that basically covers exactly how the investment strategy works, but there are just a few other factors that I think are important to consider when using this investment strategy that may be more or less relevant depending on your own circumstances. The first thing to consider is the trading fees and the account value that you're actually investing with. So with most investment platforms, they charge you fees every time you buy or sell some shares. With some platforms, this might be a flat charge every time you just make the transaction, or sometimes it might be a percentage commission taken from that investment. So what this means is that your total account value might be affected more or less depending on what increments you buy your shares in due to the trading fees. So for example, say you want to invest £100 a week into your investment portfolio, but the investment platform you use charges £10 every time you take a trade. This would essentially mean that you're at 10% loss every single time you buy your £100 worth of shares using this platform. So it'd be much more cost effective to invest £400 a month rather than that £100 a week. So rather than being 10% down on every trade, you'd be 2.5% down, which is less significant. But that being said, there are investment platforms out there that don't actually have any trading fees, so especially for smaller accounts this can be really beneficial. The next thing to consider is when to sell your investments. There's really no simple answer to this, but the idea is that with this particular investment strategy, you're investing for the long term. So if you've done your part in finding winning stocks for the long term, there shouldn't really be any reason to sell. With that being said, it can be sensible to sell off some profits, but also just look for optimum buying opportunities to continue putting your money into these investments. So for example, in March of 2020, we saw most world markets drop by about 30% due to the impact of the pandemic. Now crashes like these happen all the time in the stock market due to the volatility, albeit sometimes not as significantly as this one. But they're not something to really be scared of or let you get put off investing. And we can see with hindsight of this particular crash that most markets have recovered, and certain markets have recovered exceedingly well. So there's no reason to panic sell, simply just carry on buying more as long as you still see value in the investments. Now if this investment strategy sounds appealing to you, there are a few platforms out there that make it really easy to implement if you maybe don't feel disciplined enough to actually put that money into the investments yourself. My personal go-to would be Trading 212 using their pies and auto invest feature, where you can set up a monthly, weekly or daily investment plan if you want to into your chosen investments. This is also a solid platform if you have the discipline to do it yourself as well, as they offer no trading fees. Another alternative which could be good is Free Trade, which also has zero trading fees, but again you'll have to be disciplined to buy the investments yourself. With both these platforms you can actually get one free stock if you sign up through a referral link, so I'll leave a couple of links down below in the description if you want to use those and get free stock. Other platforms that might be appropriate are the do-it-for-me investment platforms, so that would be things like Moneybox, Wealthify and Nutmeg. They do a really good job of making it easy to put your money in and getting it invested on a consistent basis. And they're especially good if you don't want the hassle of finding winning stocks for yourself. However, that being said, if you do take the time to learn the skill of how to find winning stocks, it can be far more profitable in the long term. Okay, so the final thing to cover is basically just what I think of this investment strategy and how I use it myself. So I personally use dollar cost averaging as a foundation for my own investment strategy, but I don't actually stick to it rigidly by investing on a certain day of each month, for example. Instead, I invest a certain amount each month into the stock market, but I use a bit more of my own time looking for preferable buying opportunities over that monthly period. So for example, I always look to buy on down days or times when some news has come out that negatively affects the markets. And at times where there's a significant dip in the market, I sometimes try to buy more than my monthly quota. Now like I said, this does actually come at the cost of my own time, but personally I actually find it to be more profitable, and I actually genuinely enjoy keeping up with what's going on with the markets and my investments. So for me, this slight alteration to the strategy, I feel gives me the best of both worlds. But there we have it, that basically covers everything for today guys. I really hope this did provide some insight into dollar cost averaging and my personal investment approach. Now if you did make it this far, thank you so much for watching. And if you did enjoy the video or feel like you learned something new in any way, I'd really appreciate it if you could smash that like button, as it does really help me out with the YouTube algorithm and basically allows YouTube to share these videos to more people that might find them useful or interesting. And like I said, if you are new around here, this really is the place to be for all the most relevant information on UK finance. So if you want to know about the best bank accounts, credit cards, as well as content on investing, making and saving money, this really is the place to be. So if you're not already, make sure you hit that subscribe button down below and click that bell so you never miss a video. And if you do have any questions, feedback or video suggestions, make sure to just drop them down below in the comments as well, and I'll make sure to respond to all of you. But with that being said, take it easy guys and keep saving.